Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Back in studios here in Florence, Kentucky. Yeah, we're still in Florence.
Y'all.
That's right, y'all. Welcome back, to headquarters here for today's podcast. This is officially episode 50, if I'm not mistaken.
Yeah, it is episode 50.
How about that, man? 50 in totality on
50
YouTube.
EPs.
Yeah. So not quite the century mark. We'll maybe do something special for that. I think I mentioned to the audience last time that I won't be in Florence, at least not in this office, for too much longer. We'll finish the year up here, and then in next year we'll be our new HQ. Will be in Ohio, in the Cincinnati area. I mentioned a specific location last time, and that was a thing, but couldn't come to correct terms on the length of those terms there with the property manager. So we're still moving. In my opinion, I actually like the space better. Mount Lookout, real close to my in-laws as well. That's not necessarily why I love that space, although I do love my in-laws. But we're real close to the CPA firms we work with, the attorney firms that we work with for our customers. And it's just a cool spot. I just like the spot better than the other spot would have been, given that it's like right there where a lot of people want to move to and, either renting a place or owning a home there. So I'm just excited about the move in general. Yeah.
Yeah, I'm excited too. I mean, this has become kind of a second home here, in Florence. I've enjoyed the time that we spent here. Certainly, we've done a really good job building the podcast. And I know that Shepherd Wealth Management has flourished. And for those of viewers that are just now tuning in,
welcome.
Joshua and I knew each other before we started this podcast. So to see you start something, especially in such a dire time in the pandemic, and see it flourish, that has been the actual true joy. And I really do mean that.
No, I mean, anybody can start a business, a financial services business right in the middle of a bull market. We just wanted to do it in the bear market that we haven't had in like 15 years.
Yeah. Yeah.
Just to see if we could survive. And not that we not just survive, but we've been thriving. Which is awesome.
It was your hot girl summer.
That's right. So we'll talk about that. But we got a lot to talk about today.
Yeah, we do.
Pick your topic. We could go UAW strikes. We got a speaker that got ousted. We got a JOLTS report that, for whatever the reason, freaked everybody out. Interest rates are just spiking to 17-year highs. We got curve. CPI coming out. The yield curve is trying to de-invert. ISM manufacturing data, all kinds of good stuff here. So I don't know if there's a place we want to start, but here's where I want to start is the Bengals have to win on Sunday. They're playing the freaking Cardinals.
It is a must-win situation.
And I don't watch all the interviews from the players and so forth, but it seemed like they all took it like, this is our season right here. If we jack this game up, then might as well potentially pack it in. So I'm excited to watch them, but I'm also extremely nervous.
Yeah.
And hopefully they do better this time.
I have a lot of, unlike Bengals teams of my youth, I actually have a lot of respect for the mental fortitude of this team. I feel like that they do really care and they want to win. They know they can win. So I'm optimistic about it. But as they always say, any given Sunday, you still got to play the game.
Got to play the game. I got a quick message on YouTube. It was, where's the new office? So Mount Lookout. I don't know if I mentioned that or not. I'm actually going to go see it this afternoon. I haven't seen it yet. My wife FaceTimed me when I went to go look at it, and it looked awesome. Looked like exactly what I wanted. So I'm going to go see it today and hopefully go sign the paperwork. So I just wanted to get that out there real quick. But yeah, man, I'm with you. I think that a lot of respect for these guys. You're getting a lot of bad press right now, mostly just due to the fact that they signed Burrow to that massive contract, which is well-deserved.
Yeah.
And it just hasn't lived up to the hype just yet due to the injury and so forth. But I don't want to make excuses, man. These guys are professionals. They got to perform just like I'm required to perform.
Yeah,
they're just on the national spotlight. It's just like every other person that wakes up and gets out of bed every day, hits the alarm clock, and has to get after it. So I don't want to make excuses for them, but they're also competing against, in their field, the very, very best of the best. So give them a little bit of grace, and I think they'll be just fine this weekend.
That's true. And, also, they could die from their job.
Well,
or get really hurt.
Well, we're certainly hoping not for that, but definitely putting the body on the line.
Yeah. That's not happening on the video editing career that I have. So,
Well, not yet anyway.
not yet.
Who knows?
Waiting for that full contact league to come out.
Yeah. Could happen. You never know. All right. So we will keep an office in Kentucky, by the way, for those that are worried. And I know that that's all my Kentucky folks. Don't worry about that. We'll have a spot here to meet in the Kentucky area. So more to come on that. And we're going to be doing some different things with the podcast. I want to give a little teaser. I don't know if you want to talk about that just for a minute, Ez, before we jump into today's highlights.
Yeah, well, YouTube has just kind of opened up a plethora of options for us. So we're looking for some remote podcasting that we can do, not only to help continue the stream that we have going on kind of on a bi-weekly schedule, but also to be able to facilitate contact and access to some clients of Shepherd Wealth Management as well. We're looking to expand in that way. So we don't want to maybe let the cat out of the bag too much. We still got to work out some technical issues and do some trial runs, but we're excited. Definitely, I think our goal was post-Thanksgiving to be able to do these remotely.
Yeah, that's the game plan. That way, no matter where I'm at, what I'm doing, what's going on in the world, we'll be able to deliver this program for you all. And why it's so important, why we've gotten so much good feedback, both in difficult years for an investor like 2022, as well as this year, which was supposed to be a tough year, which hasn't been. We're here to not only tell you what's going on and why, because you can get that right from the news yourself, like completely for free. You don't have to watch any podcast shows for that. But where they drop the ball big time for the individual investor that truly wants to learn how to do a better job of managing their portfolio, the risk, understanding what type of performance expectations they should have and why things are going on. You have to go look back at what history has to say about similar events. There's only been one event in the history of the stock market and of mankind that has never had a precedent before, and that's the global pandemic where we shut down the entire global economy. Maybe the Spanish flu back in the 1800s was the one other thing that you can point to that was, quote, similar, but I would argue that it's dramatically different given the fact that our economies are so intertwined with supply chains and all that sort of stuff. So there's no precedent for that. But outside of that, there's always been a precedent. Higher interest rates, inflation issues, job issues. I mean, we can go on and on. You can pick your strike issues. I mean, you could literally go back in history and point to multiple other periods of time where these things have happened. And Warren Buffett famously said, the one thing we know for sure about human beings is they do not learn from history. Now, history, for all the compliance people out there listening to this, of course, past performance does not guarantee 100% of the time that past history will repeat itself. And clearly investing involves risk, including risk of loss. So there's your disclaimer there. But if the greatest investor in the history of not probably our generation, but arguably of all time, that has outperformed the market by 2x over a 60-year period, is saying that human beings are not willing to learn from past experience in history, that's an edge for the individual investor. I'm trying to deliver an edge for you.
Yeah.
And also fill a gap that the news outlets just simply, for whatever the reason, don't want to spend time bringing to your attention. I'm not sure why that is, but we're here to deliver that information to you. That way you can actually look forward and say, okay, if this happened in the history, now I'm putting some probabilities in my favor, knowing that it might not work out 100% to the T in the exact same time frame as what history had to say. But markets are forward-looking. They're looking 6, 9, 12 months out. And if you can understand what history had to say and the events that happened after that, now you can actually build a game plan for your asset allocation. I mean, that's the one of two things that you can control is your asset allocation. That's just a fancy way of saying this is how much of your money is invested in stocks, bonds, and cash. And the good news about controlling that explains 94% of the variability of performance in investors' accounts over any period of time that you want to look at. That is excellent news for the individual investor. You can control 94% of the variability of your accounts. That's great. And the other thing that history lesson gives you, not just a game plan for how to attack your asset allocation and give you an idea of what performance should look like based on that historical precedent, at least give you the probabilities of that.
Yeah.
But it also will control your temperament, your emotions. You're not going to receive all this information, which, by the way, the news is primarily made up of bad news because that's what grabs people's headlines. And it's not just the headline grab, it's the emotional grab. Like literally, if you study human beings and how they make decisions with their money, you would know that, based on the study of behavioral finance, we feel losses twice as much as we feel good about making money. It's that fight or flight that's built inside of us. We're all by nature risk averse. When things are bad, we want to preserve things and not hurt ourselves to try to survive and move forward. But that's how I can control that emotion, is by understanding what history actually had to say and what happened after those similar events in the past. So that's why we bring this show to you, is to fill the gap that the news, for whatever reason, is unwilling to do. And it's also so that you can control the two things that are the most crucial, in my opinion, to control to have sustainable long-term success with investing. So there you go.
Yeah.
Welcome to the show. There's a lot to get to today. I'm going to start with, I guess, the most recent stuff and then work my way through the last couple of days.
All right.
So
let's do that. That's the proper schedule for the big XL, the 50.
Yeah, that's right. And here we go. So jobless claims, we just got that today. Jobless claims came in at 207,000. It was an increase of 2,000. So additional 2,000 people added to jobless claims from the prior month. The problem is that the market consensus, economists expected 212,500 in jobless claims. So we had fewer people on jobless claims, even though it went up a little bit. But that, unfortunately, that good news of more people being at work is actually bad news in the market today, simply due to the fact that there is this fear of individual investors thinking that, well, if the job market's this strong, inflation can't be tamed. And therefore, the Fed and Chair Powell are going to have to stay engaged with these interest rate increases. Obviously, that's an issue in the minds of individual investors. I have something to say about that, of course.
Well, let's hear it.
Here in just a second.
Oh, okay. Yeah.
Now, we do get a very big employment report tomorrow. So I give you the news of today, which has caused the Dow to fall by 0.5%. Looks like the S&P is down 0.75%. And the NASDAQ is down a whole round 1% here as I'm delivering this information to you. Employment tomorrow, 8:30, we get this number here. And economists are expecting about 163,000 new jobs in the prior month. So if we come in higher than that, meaning more people got a job in the previous month, that could be a bad thing for equity markets tomorrow. Again, with the same premise idea, is that we have such a strong labor market that will force the Fed to stay engaged, because if we have a strong labor market, that means we can't have disinflation. I completely disagree with that. I think that you can have a very strong, healthy, robust job market and actually see inflation falling and staying under control. I mean, hell, we just got that report last Friday, the PCE, which is the favorite Fed measure of inflation.
Yeah, it's their PCP, if you will.
Came in at half of what economists expected. But nobody cared, because of the other freaking topic that I got to talk about today, is that this government shutdown was literally the market popped more than 1% across all the major averages when the market opened up with that news. And then at 10:30, an hour into trading, nobody gave a crap, because it was all about headlines, government shutdown, all this stuff. So the market is very much this hair trigger nervousness as it relates to all the headline news. But let me break something down for you, for those that are listening to the program here. Not only did core PCE come in the way that I just described, and nobody cared about it because, again, the headline news, hence the reason why we're doing this podcast, is just to get you over just the headline news. Nothing changed between last Friday and today, October 5th, 11:25 p.m. or a.m. Eastern Standard Time. Nothing changed on the two most important things that would drive the bond market, in other words, the yield curve. One would be the expectations of inflation itself. That hasn't changed. There is nothing that changed between last Friday and today where you would expect inflation to all of a sudden take off. Inflation expectations have not changed at all, number one, but yet the yield curve is spiking. We're seeing 17-year highs on the 10-year Treasury note. We're talking about 100 basis points, 1% move in the 10-year since the summer. That's unbelievable. And it had nothing to do with the expectations of inflation. Again, it's been falling, and that expectation has not changed, to reiterate that. The other thing that would move interest rates from a fundamental perspective is a change in GDP, the change in the growth outlook. That hasn't changed. I mean, hell, the expectations for earnings actually has increased.
Yeah.
If nothing less in the last few days, leading up to earnings that we're about to get starting next week. So this is truly the reason why I do what I do, not just from the podcast perspective, but as a fiduciary, a true fiduciary professional here in the financial services industry, is here to tell you what you're just not getting on any of the news outlets. None of them. CNBC, Fox News, all of them. They're all focusing on the things that are going to drive the most eyeballs. And I'm not necessarily disagreeing with their business model, because that's how they sell ads based on viewerships. But damn, man, how about you actually get into the actual important stuff here that people need to know so that they can actually understand why things are happening the way that they are, and whether or not there's some sort of dislocation between fundamentals and what history has to say.
Oh, 100%. I mean, I, like you, can understand where their approach comes from, but it's still sleazy and misleading and doesn't actually do anything to educate anyone. It just makes it entertainment.
Crazy.
You know, it's just like a living horror movie. That's it, because they know that's what people are going to pay attention to.
And what sucks is I don't want to root for, fewer people having a job. Like, I don't want to do that.
No.
I'm never going to do that. I'm not going to be excited if we have, 100,000 people that actually got hired. The last ADP report.
Fired.
We got an ADP report just 2 days ago.
Yeah.
And I think the government expectations for ADP, so new people on payrolls, was supposed to be well over 100,000. It came in like 89,000.
Okay.
That actually rallied the market yesterday. NASDAQ was up over 1.2%. I think it finished like 1.3 or 4, something like that. So it was a really good day for the NASDAQ. It kind of broke a losing streak across all the major averages. And the only reason why it really rallied is because there were fewer people that got a new job than what consensus is expecting. So people are literally rooting for a slowdown. And I get that they're rooting for that because that's what Fed Chair Powell said, and that's what he wants to see happen, because that's a way that they can actually control some of the inflation. But I will never root for that.
No, you've said on previous podcasts many times that that's the most un-American thing to do, is to hope people lose their jobs.
Oh, I mean, they have a mandate, and it's a dual mandate. I'm going to speak more about this in a second, but one of them is maximum employment, and the other is price stability, and that's inflation. So
is the Fed's mandates?
Yeah, that's the reason why they were created. I'll have more to say about that specific mandate here in just a little bit. But tomorrow, 8:30, big day. Relative to the markets. And if it comes in line or lower, then you're probably going to see a really strong rally. If it comes in hotter, you're probably going to see a lot of selling off in equity markets, and you'll probably see interest rates move. But to me, that's not really a good way to go about viewing your portfolio. We're going to have to get into the actual real data. As I mentioned, earnings would solidify the GDP expectations that we have, and plus we'll get GDP data. And the other thing would be inflation. We're going to get the CPI print on Thursday of next week. So those are the two important things to me. But tomorrow we have to be paying attention because it will affect short-term things as it relates to the market as well as interest rates. Now, one of the things that people keep talking about with me as I go and do my quarterly reviews with customers is like, well, you got energy prices have been spiking over the last couple of months, and therefore that's going to keep inflation elevated, and therefore the Fed's going to have to stay engaged. Now, I agreed with them that energy prices did spike, but we expected that. That's why we had a little bit more in energy exposure for customers leading into the biggest travel months of the year. However, human beings are not buying barrels of oil. We buy gasoline. There is a difference. So just the other day on Wednesday, I believe, there was a 5% drop in the price of an oil barrel. And specifically, West Texas Intermediate Index dropped 1.8% down to $82.73 per barrel. And really what this is about is OPEC announced that they would not increase and or decrease their production. They're keeping it the same. So oil inventory is in fact building which means the price that you're paying at the pumps should be coming down. And that is actually disinflation from a headline perspective. Of course, it's not really going to be something the Fed gets too concerned about related to core inflation. It's just simply due to the fact, I mean, people ask me this all the time. You could raise interest rates on the Fed funds to infinity. It has nothing to do with the price of oil. That's basic supply and demands. And last time I checked, the Fed has no oil, wherever they're hanging out at having these meetings across the country. So not too concerned about energy causing additional inflation for all of those that are worried about that. I did want to talk a little bit about some recent economic data as well, since we're on the topic here. We just got it the other day as well. ISM manufacturing data came in exactly as expected, but people started to get a little anxious around the prices paid. It came in at 58.9, and they're saying, well, above 50, that could drive inflation. But these are prices paid, and these are services, right?
Yeah.
There is always going to be service inflation. You can't just say, I'm not going to pay for stuff, I guess. But the reality is, if you go back in history, pre-pandemic, we're at the exact same level on the prices paid measure here for manufacturing as we were pre-pandemic. So that's really not an issue from an inflation standpoint for all of those that were worried about that. And now I wanted to get into the movement that we've seen here in the 10-year yield. So I'm going to give you all some facts real quick. So the 10-year government bonds for all sovereign nations, took a look at that. And right now, as you would expect, Russia's 10-year government bond yield is at 18%, and Turkey's at 24%. So those are the highest 10-year yields of sovereign nations at the moment. The U.S. is at 4.7, 4.75 roughly, depending on the hour in which we're looking at the data. And let's compare that for just a second to other European nations. So Germany, 10-year at 2.9. Spain, 4% on their 10-year. Greece is at 4.4%. And Japan is an outlier. They're at 0.80%. Now, I give you all this information to basically just have a little logical conversation here.
All right.
You ready for this?
I've been waiting for it for 2 years.
We can understand the Russia-Turkey thing, I think. But when you go over to Europe, Germany, Spain, Greece, and Japan's not in Europe, but when you look at all this stuff, I think that there's a fundamental dislocation here because Germany, Spain, Europe in general is having a way worse time with inflation than we are.
Yeah.
Yet their 10-year yields are substantially below where the U.S. 10-year is. Why is that? Right? Oh, that's a great question that nobody wants to ask. Why is that all these other countries that have a way worse of a time handling inflation, they don't have the robust economy that we do to deal with it the way that we could, but yet their 10-year treasuries are trading dramatically different than where the U.S. 10-year is. And I just think there's some sort of fundamental dislocation about that. And my argument is why this is, if you're asking me, and this is just me and Ez and the rest of the YouTube videos here just having a conversation, right? Like instead of me having a coffee, this is like we used to do those happy hours on the deck. Drinking a beer. This is my perception of this. I don't have any actual concrete fundamental data to explain why the 10-year is trading so much differently in other parts of the country, specifically the parts of the country that we're allies with and they have a way worse issue with inflation. So here's my thought on this. It's because the United States investor is completely gripped with fear with these headline news. As I mentioned, nothing has changed with the fundamental expectations of inflation and or GDP or growth in the last couple of weeks, but yet we've seen the spike in the 10-year treasury, right? It has everything to do with the perception and fear that people have because the Fed said there's too many people with a job. So that in and of itself is causing people to freak out. Now, I don't have a better answer than that.
Yeah, I don't have any answer.
Well, I'm not looking for one, but I'm like, why don't we just all wait and see what the data looks like? Because the reality is we've had the data going in the direction that we're looking for. Jobs have not been destroyed, even though the Fed has increased interest rates at the fastest pace and at the highest level than it ever has in the history of the United States outside of 1980, 81, 82, where Fed Chair Volcker took the Fed funds to 20%, right?
Yeah.
To completely squash inflation. So that's just me spitballing on that idea, but I don't think anybody really knew. At least this caught my attention when I saw the data, right? I don't think a lot of people understand that the other countries that we do business with, their 10 years of trading dramatically different than ours is. And I think that there's something to that. So moving on, as we talk about the rise in interest rates, that does affect the way that this country in the United States has to finance itself.
Yeah.
More to talk about that here in just a minute. But Goldman Sachs came up with an estimate. So looking at the U.S. debt interest cost as a percentage of GDP, right? They think that it could reach a substantial peak here by 2025. Right now, the U.S. interest expense is about 2% of GDP, roughly, at least when we look at 2022. They think it could double to 4%. Now, it might not sound like a lot, like, okay, well, 98% of the GDP is not being used to pay the U.S. deficit's interest, right, and debt. But if it doubles between now and 2025, I mean, that's a big move as far as the cost to finance this nation's debt. And it's not like we're all of a sudden going to run a surplus where we have, we're chipping away at the $32 trillion that we're sitting on in debt at the moment. So I get that could be a potential headline risk, but that, in my opinion, could be solved. And I think Buffett is a huge proponent of this. I can't tell you exactly when he said this, but I do believe he said this at his most recent shareholder meeting that they always have annually in Omaha, is that a huge way to solve that problem is just to simply grow the economy.
Yeah.
You get more growth. That's without even getting to the entitlement conversation, which I don't want to talk about today, because that everybody has a different opinion about that. I know a lot of people on CNBC. I can't remember the guy's name. I could tell you it was just a couple days ago. A billionaire came on at like 7:30 in the morning. It was like, well, they could just go ahead and say all of those that aren't born yet, they don't get Social Security, and why would they care? They're not even born. So who cares about that? There's a lot of rabbit holes people can go into, which is why we don't want to have that conversation. But the one thing that we could do is focus on growth. Growth would work because we have all the advantages for growth without having to piss off a bunch of people.
Well, also, using the unborn and future generation as commodities now is kind of a big part of how we got into this problem.
Right.
So I wouldn't advocate for that ever.
Right. So here we are with dealing with how to finance the government. And that leads us to a hot topic of conversation here today. So former Speaker McCarthy has now been voted out of his speakership role.
Yeah.
Obviously, that's been a huge headline news. It's been a headline since last Friday. Like I mentioned, we got great core PCE number. Everybody cared till they didn't, and had everything to do with this vote on keeping the government afloat. Now, this is definitely not a political show, and I am not a political person. I don't care who you vote for. You don't vote, independent, Republican, Democrat. Here's my deal, and we talked about this before the show.
Yeah.
Is elected officials across the spectrum, mayors, whoever, to the highest level of government, their job is to service those that got them there. And not servicing millions of Americans is a big enough problem. But here's the simple truth. The first people that don't get paid are those that are serving this country in the military.
Right.
And guess what those people are going to do if you shut down the government? They're going to soldier on without a paycheck, protecting your ass, right? And sending them to places that they don't probably want to go, that's scary as hell, away from friends and family, and who knows when they might get to speak with them again. They're willing to soldier on and take your marching orders without a paycheck. That's not cool with anybody. I don't care what side of the aisle you sit on, don't sit on. Like, that is ridiculous to me. And that should be all that you would have to say to come to some sort of agreement, because the reality is, since the beginning of this country's inception, when they wrote the Declaration of Independence, you weren't all supposed to have the same view. We're supposed to have our different views and then actually come together. Not everybody wins. Actually, everybody kind of loses, but it's all for the good of the individual American society that you have to actually give up something. in order to get something.
Yeah, that is a pessimistic, glass half empty way to look at compromise, but you're exactly right. That's the whole point of it, is you have all these different paradigms that come together and they vote on a general good that touches everyone in a fair way.
No doubt.
I can't remember the last time it's actually happened, but that's what it's supposed to be.
Right. And it's just disappointing. I still don't believe that. So I've always said this. I get asked this question every time this comes up, and it seems to come up way too frequently now. People or individual groups of people trying to hold potentially, the U.S. Government at hostage just to try to get some leverage.
Yeah.
And I'm all for trying to leverage your agenda. But this headline risk of government shutdown comes about way too frequently, in my opinion. And the reality...
I mean, it's going to come back again in November.
Exactly.
That's the only time they bought us. It's 45 days.
Right. You got 45 days. But I don't... So here's my answer every time I get asked a question. And this is what history has to say about this too. Is that in general, although there have been points in time where governments have shut down, and if you actually look at the history of points in time where government did shut down, that actually wasn't all that bad for the market because nobody could do anything. Although, again, I don't root for any of that stuff. I don't think it's good. The points in time where the government might shut down from a historical standpoint, the thing that usually wins the day is self-preservation. And I still think that even if they don't have this fiasco in Congress figured out by the time we roll into November, even though it might take all the way up until the final hour, I still think they'll find a way to at least kick the can down the line. I don't think that there's going to be some sort of overhaul and spending and coming up with this great way to finance the United States government for an extended period of time until they have to vote on all this stuff again in Congress. But I just don't believe that the rest of the folks that are in the position to vote on funding the government will allow that to happen. That's just my opinion. I could be completely wrong about that. Nobody really knows until it happens. But I think this whole concept of self-preservation is a pretty powerful thing.
Yeah, it'd be great if they thought about that in the scheme, the altitude of the entire country and everyone, like they're supposed to be doing. Instead, they just think about themselves. I believe it's our patron saint of the show, Warren Buffett's opinion. I think, didn't he say last year, or the last time we went through this was they should just get rid of the debt ceiling. That's really the only way to manage effectively, grow the economy and get rid of the debt ceiling so we don't have this ability to hold each other hostage.
Yeah.
And we focus on making America as economically powerful as possible.
I think that'd be awesome if they passed some sort of law where they can't not fund the government.
Yeah.
I mean, that's...
Yeah, and he wasn't advocating for reckless spending. He's just saying get rid of the limit,
right,
and then grow the economy.
I'm with you on that, man. But I guess Buffett missed his window to run for president. I mean...
Yeah,
he's a little long in the tooth from an age perspective.
Well, he'd fit right in Congress. You're either a 40-year-old nut job or you're 80.
Who knows? Yeah, who knows? Mitch is hanging in there, though. Keep hanging in there, Mitch, I guess. But, yeah, I mean, that's some of the stuff that we've seen in the highlights as far as, like, headline risk. Mm-hmm. And I understand. If you sit here and list out all of the things to be worried about, you would have a list longer than my 5-year-old's Christmas wish list. Like, it would be out the door here in my office of all the things to be concerned about right now. And there always will be things to be concerned about, whether you're investing and participating in the market or not. And truthfully, at the end of the day, you might be wishing, or we might be wishing, that we would have spent all of our time, energy, and effort building a bunker and buying a bunch of bullets, guns, and canned food and water. But who wants to live a life of fear?
Yeah.
I certainly don't. And I try to not allow my investors, my clients, to mentally go there. And that's why we spend so much time talking about the stuff that we do and providing the historical context that surrounds it.
I agree. That whole hope for the best, prep for the worst can be taken too far. You got to spend the time to manifest the best too and put effort into that.
Yeah, because guess what? You guys might be wrong.
Yeah.
And if you're wrong, that $5.6 trillion of cash that everybody's been sitting on, outside of my clients here at Shepherd Wealth Management, we've been participating in an intelligent way based on what history has to say that's allowed us to outperform the market substantially without taking on additional unnecessary risk. Mm-hmm. If you guys are wrong, then obviously, that's going to be a you problem, not a Shepherd Wealth Management problem. And maybe you should give us a call at 513-630-2664, and we'll get you straightened out here. Because the other side of the coin is inflation is in fact continuing on this glide path lower.
Yeah.
And jobs are still really good. Growth, GDP is still really, really strong above historical averages. And earnings for corporate profits should remain very stout as well. And if that is in fact the case, I am going to sit back, prop up my feet on my desk, and allow the rest of this year to go by and not worry about a damn thing. I'm going to go into next year preparing for an election year, which is, again, its own headline risk. And I'm sure I'm going to be talking about that for an extended period of time.
Oh, yeah. Go back to season, what was it, 2, where we talked about, or season 1? We had the midterms. We had to talk about that, the effects on the market, the historical precedents for that.
Yep, absolutely. So a lot to come on that. Now, as I think forward, so this is the conversation that I'm having with customers right now. So you got, in my opinion, one of two things could happen here. Either inflation's on this glide path lower and we don't blow up our strong job market right now. That's the two boxes that the Fed has to check to say that they're doing their job well. Maximum employment, price stability. As we look into 2024, at the moment, there is no pricing in of any rate cuts. Zero. And it's because the Fed chairman in the last meeting said, hey, our dot plots say that we're going to keep our Fed funds rate either here or right around here, depending on the data that comes out in inflation. We expect earnings to be good, growth to be good, but we're also going to keep our Fed funds rate right around this level all through next year with zero rate cuts. So there's no rate cuts baked into the stock prices at all. But if you go into next year, and again, employment hasn't been destroyed, we still got maximum employment, which would be defined as an unemployment rate right around 4% or less, which is where we're at, and inflation's on its glide path towards 2%, why in the world, how could you possibly justify keeping Fed funds rate where it is? You couldn't. Therefore, at some point, sooner than later in 2024, the Fed will have to cut. And if that's not baked into stock prices today, that's a huge tailwind for stocks across all the major averages, specifically for those stocks that are what we would call most correlated with easing of financial conditions.
Yeah.
We talked about that in prior podcasts, so go back and listen to it. I'm not giving that lesson here today. So that would be a huge win for us from an asset allocation standpoint, meaning we wouldn't have to change all that much going into next year. And in addition to that, you still got the $5.6 trillion of investors' cash sitting in either cash or money markets that could go into equity. So there's another massive tidal wave of money that could push equity prices higher. Now, I could be wrong, and inflation could spike, and that would completely change the way that we would want to have our investors' asset allocation mix within the portfolio. So I told people literally today, and I'll continue to meet with them throughout the weeks here, and going over this exact same information. And if we're wrong about inflation, it'll be very obvious. We'll know it very quickly. And the good news is we've made more than the gains than the market has this far this year. So it's not like we'll be underperforming the market. We can simply rebalance our positioning to something that makes more sense in a higher for longer, potentially more interest rate increases, no interest rate cuts type of asset allocation going into an election year. And another thing in general that I'll say about the history of election years is regardless of who wins, I know everybody wants their candidate to win, but regardless of who wins, if you go back over the last 100 years of the market, an election year is going to average about 10% roughly, which is the long-term average of the S&P anyway. So you have that to chew on. Regardless if your favorite candidate wins, the market's still going to move on, with or without you. And in addition to that, usually in an election year, the first quarter is not all that bad because you're coming out of Q4, right? And you're getting all those earnings to show up in Q1, and in general, Q4 is a strong part of the economy. So Q1 could be pretty good regardless of what inflation's doing going into next year. But those 2 quarters after that, basically from around the end of March all the way up until the point in time where we actually have the election results, not so great because of all the uncertainty about who's going to come out on top. And then once that uncertainty's been removed, generally speaking, markets become quote unquote more normal. Although I would say over the very most recent couple of weeks, anything but normal has been happening here.
Ugh.
I think we've given the listener, the watcher here, if you're watching this live on YouTube Live, thanks for watching. But we kind of given you a list of all the major headline risk and how unfundamental some of this data actually is relative to our other peers and so forth. So it's been a wild couple of weeks to start out. They're finishing up the last week of September, and then beginning of Q4 now here in October, with still yet nothing but headline risk causing people to, in my opinion, over-concern themselves. And it's frustrating. Like, I wish I could be in the living room of all these households to help, give them a different perspective at the very least. I want to say, like, get them on the right path towards sustaining long-term success, but just giving them some encouragement, something other than what they're getting on the news on a daily basis.
Yeah. Well, we are reaching out and touching America with this podcast. So hopefully.
So you guys got to watch it. You guys got to share it. You have to, leave some comments for us. Even maybe you disagree with some stuff, maybe we can give you the information in a different way, and so on and so forth. But I just think that a lot of this stuff is just simply not talked about, and you all deserve to hear it. So please share it, like it, subscribe to it, hit the notification bell, so every time we do this, you're alert and aware that this is out there for you. And you can go to our website, shepherdwm.com. Gives you all of our background about the firm, what we're here to do, who we're here to serve, how we go about doing it. But it takes you right to our YouTube live page. If you're walking the dog, going on a run or something like that, you can listen to us on Spotify while you're doing that. And of course, we're actually posting all the literature, all the monthly newsletters that we write. We try to do a blog every Friday. It doesn't exactly work out that way, but we get 2-3 blogs out there on Fridays. All that stuff's available to you right on our website completely for free. So I'd like you to take advantage of that and love your feedback. So I think that's everything I had here today. Ez, we got any last bit of topics we need to remind people about or anything?
I don't think so. I mean, this was a lot. This was almost cathartic.
Yeah. So we all are going to go throughout the rest of our day here today on this Thursday. Hope you all get a great night's sleep, and anticipating hopefully good news from a jobs perspective tomorrow morning at 8:30, because it's truly going to determine how tomorrow looks.
Yeah, I want the jobs fairy to come and bless us all.
Absolutely. So it's been fun. We'll do this again in a couple weeks, and hope you guys have a great rest of your day. Take care.